All right, so the next topic is bonds. So let's pick up where we left off. And bonds are a topic that you guys hear about stocks and bonds all the time, but a lot of people don't know how bonds work. So let me kind of explain the overall concept of a bond. So when you need money in your business, you have a few basic examples of ways to get money in your business. And so we talked about debt financing and equity financing. Debt's when you go to the bank and get a loan, and equity is when you get money from ownership. So you get money from stockholders. But another option that exists is bonds. And so if you go to the bank and get a loan, then you make monthly payments and it's this continual thing, right? So with a bond, what happens is you borrow money from investors. So let's pretend that, well, let's do an example where we need money in our business, and the way we decide to do it is through bonds. So I want you guys all to be my students. And so usually I look at all of you guys and I'm like, all right, I am a business, I need money. So I'm going to get each of you guys to give me $1,000. So let's pretend that there are 30 of you. Each of you give me $1,000. So now I'm the business and I have $30,000 that I got from each of you. You are going to be my bondholders. And so I'm going to pay you, let's say 8% interest semi-annually for 5 years. So I'm going to say that again. You guys are my bondholders. You gave me $1,000. I'm going to pay you 8% interest for 5 years semi-annually. Semi-annually means twice a year. So if one student has $1,000 bond, then 8% of 1,000 is $80. I'm going to pay that semi-annually. So I'm going to give you $40 every 6 months. So follow me through the transaction. And you guys gave me $1,000 today. Every 6 months, I'm going to give you $40, $40. Every 6 months, you're going to get a check in the mail for $40. At the end of 5 years, I'll give you your $1,000 back. That's how a bond works. So you buy a bond up front, you pay $1,000 for it. Bonds are usually sold in $1,000 increments. That's why I used 1,000 as an example. And so after the whole life of the bond, at the end of 5 years, you get your $1,000 back. You get interest only throughout. So me, the company, what I just got was basically a loan for $30,000 where I have to pay interest only for 5 years, and then I have to give the principal back. And in 5 years, if I don't have the principal to give it back to you, then I'll go find 30 more people to give me $1,000 each, and I'll lock in an interest rate with them. I'll take their 30,000, give it to you guys, and keep going. So that's how bonds work. So it's considered a long-term liability for the company because bonds last for longer than 1 year. And so they'll have a maturity date. My example was 5 years. They have a face value. My example was 1,000 each for 30, so 30,000. And they have a stated interest rate. The stated interest rate in my situation was 8%. So the bonds will have a price. And so the issue price is the $1,000 if it's at the face value, but sometimes bonds sell for a premium or a discount. So when a bond is not valued properly in the market, that was a weird thing to say, wasn't it? When a bond is not valued properly in the market. So my bond paid 8%, and you guys were like, cool, I'll buy your bond. But if other bonds of similar risk were paying 9% interest, then you would not want my bond. You would not be interested in buying my bond because you could get 9% elsewhere. So the only way I could get you guys to buy my bond is I might have to discount it. Discounting it is when you sell it for less than its face value. So my $1,000 bond, maybe you guys were like, I'm not investing in you. You're only paying 8. I can get 9 elsewhere. Then I'll be like, all right, what if I give it to you for $950? And you'd be like, oh. So you'd buy it for $950 instead of 1,000. And I'd still give you the $40 every 6 months. And at the end, I'd give you $1,000 back. So you kind of get like an extra $50 at the end. Bonds can also sell at a premium, and that's when they sell for more than the face value. So my $1,000 bond, maybe my bond pays 8%, but other bonds pay 6%. And I'm like, my bond is awesome. I know my bond is awesome, so I'm going to charge you more. So instead of getting to buy my bond for 1,000, I tell you I want 1,030. And then you're like, well, I'll pay an extra 30, but I get more interest than elsewhere. But at the end, I only give you $1,000 back. So you pay that extra 30 up front to get my bond. So, all right. So I'm going to pause right here for just a minute and I'll be right back. Okay, let's keep going with our premium and discount example. So the way that it would work is, because this is a little example, it says when you get a loan, then remember that's a financing activity. So as far as cash flow goes, financing, we haven't done this in a while, but financing, and we're not going to until next week for chapter 12 when we do cash flow stuff, but getting a loan or repaying a loan goes in the financing section. And then interest is actually going to go in the operating section. So when we pay interest, it'll go in the operating section, and we'll talk about that next week. But when you repay the principal, it will be a financing activity also, because getting and repaying a loan is financing. So again, bonds are usually sold in $1,000 increments. They normally pay interest semi-annually. To calculate the interest, I equals PRT. So the principal times the rate times time. Oh, I'm okay right now. Thank you though. So, and then bond for, oh, hey, not bad. We only lost 2. I'll eat them. Thanks. Okay, so bonds are usually quoted as a percentage. So if you try to buy a bond out of the market, like if you go and you purchase a bond, then they usually are quoted as a percentage of the face amount. So here's some examples of that. $1,000 bond priced at 103. So when you see that, you're like, I don't know what that means, but it means 103% of the face value. And so $1,000 bond priced at 98. Let's do that one first. $1,000 bond priced at 98 means 98%. So we all know that, like, if you have a 98% in the class, it's like 0.98 times 1,000 is the bond would sell for $980. So that means the bond is selling at a discount because it's selling for less than the face value. And then a bond that's selling at 103 would be 1.03 times 1,000. And so that bond would sell for 1,030. So the main reason why companies choose to use bonds is because they only have to pay interest payments. And so they also, so that means that they don't have to make as big of payments along the way. Also, they can usually get a longer maturity. So you can get a 5-year bond, but you can also get a 30-year bond or a 40-year bond. So bonds have varying maturity dates and stuff. So that's a pretty big benefit to the investors. So these are some bond characteristics. And what I mean by that is these are some different characteristics of bonds that will influence like how much you might want to buy a bond. So a term bond, so term versus serial. A term bond, they all mature at the same time. So all bonds are 5-year bonds, like the ones that I sold when I sold each of you guys $1,000 bond. A serial bond has several staggering due dates. Okay, so the way I remember serial is it starts with an S and it has several staggering due dates. So some of the bonds, so it's a staggering spread over several dates. I'm kind of playing off of the S. So some of the bonds might be 5-year, but some might be 10, 15, and 20. That way they don't have to come up with, the company doesn't have to come up with the principal all on one day. So a convertible bond is a bond that can be converted into shares of stock. So remember how you guys all bought $1,000 bond from me, and then I paid you interest every 6 months, I gave you $40. So if the bond was convertible, then at any given point during the 5-year period, you could trade it in for shares of stock. So you're like, I don't want to be a bondholder anymore. I'm not interested in this. I'd rather be a stockholder. So on the back of the bond certificate, it might say this bond is convertible to 10 shares of stock. So every time you get interest, anytime throughout the 5-year period, you could stop and say, you know what, maybe I want to convert this to stock. So let's say that you're in year 2 and you're like, and you look at that bond and you say, it says it can be converted to 10 shares of stock. So you go online and you're like, all right, what's the stock price? And you look, and the stock price is $80 a share, 80. So you could convert your bond, your $1,000 bond, into 10 shares of stock. at $80 a share, but that's $800 for the stock. And you're like, nah, that's not a good idea. So time keeps going. And then year 4 rolls around and you're still getting that interest of $40 every 6 months, and you get your interest payment. You're like, wait, what's going on with this bond? And you go online and you look, and the stock price is $140 a share. So the stock price is $140 a share, and you can trade it in for 10 shares of stock. So then you could tell the company, I'm ready to convert, and you could mail your bond back in, and they're going to send you 10 shares of stock. Then you could sell those 10 shares in the market for $140 each, and you could get $1,400 out of your bond. So that's the way a convertible bond works. So you can convert at any point if you want to. You don't have to convert, but you can. A callable bond means the bond can be canceled by the company anytime they want. So at any given point in year 1 or 2 or 3 or 4 or 5, I could be like, you know what? I'm done with you bondholders. And I could notify you that I'm calling the bond. And then I would just have to pay you your $1,000 back and any interest, like a partial interest payment. So if it was like in the 2nd month, and instead of sending you $40, I would just send you like $10 and be like, here you go. And here's your $1,000 back. So I could call it anytime I want. And then secured versus unsecured just means, does it have collateral or not? So secured have some form of collateral. So if the company goes bankrupt, then they would sell off the collateral to be able to pay you back your $1,000. Unsecured means no collateral. Okay, so let's review the way a bond works. So it says, Caldwell Company issued $5 million of 8% 20-year bonds on January 1, 2022, interest semi-annually. So then I say, what happens? All right, so there's a lot of things going on there. It says 5 million, 8%, 20 years, semi-annual. So investors are going to give Mr. Caldwell $5 million on January 1. Now, it's probably not one investor. Bonds are sold in $1,000 increments, and there's going to be a whole bunch of people out there buying bonds. Now, you have the option of buying 1 or buying 10 or buying 100, but you probably wouldn't buy all of them, okay? So every 6 months, Jim's going to have to pay his investors interest for 20 years. So he's going to make 40 total interest payments because he's going to do it twice a year for 20 years. And then at the end of the 20 years, he'll have to give the investors their $5 million back. So let's go ahead and let's do the journal entry for this. So on January 1, Jim is going to receive cash of $5 million. Then on June 30th, he has to make an interest payment. And then on December 31, he will make another interest payment. He's basically going to do this entry every 6 months for 20 years. To calculate the dollar amount, I equals PRT. And the principal was 5 million times 0.08 times, and then it's a half a year. So you can do 6/12 because I always put 12 downstairs. And so if that makes you feel better to do 6/12, that's fine. Or it's semi-annual, so you can just take it times a half, and that's fine too. So 5 million times 0.08 is 400,000 a year. So times 0.5 is $200,000 every 6 months. And he will do that exact same journal entry every 6 months for 40 years. So somebody's going to be in charge of the bond, and who owns the bond, like who the bondholders are, and will be in charge of processing payments to all those people every 6 months. All right. So we talked about it earlier, and we mentioned that sometimes bonds have to sell at a discount or have to sell at a premium. So assume that your bond has an interest rate of 10% when other bonds are paying 12. So if my bond pays 10 and everybody else's are paying 12 that are similar in interest or similar in risk and maturity and stuff, investors don't want my bond. So the only way to get people to buy my bond is to lower the price. And that's called to discount it. Okay. So you'll need to drop the price of your bond so the investors are really getting a 12% rate of return by selling it at a discount. So if the stated rate and the market rate are the same, the stated rate keep in mind that the stated rate is our rate. So if the stated rate is the same as the market, then our bond is going to sell at face value. That's what happened to Jim Caldwell at the top there. His bond sold for exactly 5 million because it must have been priced right in the market. But if the stated rate is bigger, if our rate is better than the market, then our bond will sell at a premium. And if our bond is less than the market, then we will have to discount it. So let's go ahead and let's work through what the entries would look like if our bond sold at a discount. So McGuire Company issues 2 million of 9% 10-year bonds on January 1 with interest semi-annually when the market rate is 10. So our bond is paying 9% when the market is paying 10. So people do not want our bond because we are not paying as good of a rate as the market. So it says the bond sells at 99. So if the bond sells at 99, remember that means 99% of the face value. So let's go ahead and see what the bond sells for. The $2 million bond will sell at 0.99. So that's 1,980,000. So the amount of the discount is $20,000. So when the investors go to buy the bond, they will only pay $990, like each investor. And so the bond is selling at a discount. So we are going to have a new account, a new T account. And the name of that account is going to be called Discount on Bonds Payable. So discount is a contra liability. Now we've never had one of those before. Contra liabilities will have a debit balance. That's because liabilities are credits. So a contra is the opposite. So the opposite of a liability is a debit. So a contra liability will reduce a liability. So we are going to amortize the discount. The word amortize, we used it in the last chapter as it related to amortizing intangibles. So amortizing it means to write it off over time. So we're writing off the discount over time. And this bond is a 10-year bond. And it pays interest semi-annually. So this bond is going to pay interest 20 times. So every 2 years or every year, twice a year, semi-annual. So 20,000 over 20 payments will be 1,000 per payment. This is called straight line amortization. And that's the only method I teach you in this chapter. I don't try to do the other one. So let's go ahead and let's do the entries for McGuire. So on January 1, she's going to sell the bond. And when she sells the bond, she is going to receive, it's a $2 million bond, but she's only going to get 1,980,000 because she had to discount her bond. So skip a line. And when she repays the bond at the end of the life of the bond, she is going to have to pay back $2 million. So the $20,000 difference is a debit. And that debit's name is discount. I always say discount on bonds payable has a debit balance because it begins with a D. That's not really true. That's not the reason why it's a debit, but it is true. Discount does have a debit balance. So discount on bonds payable is a debit balance of 20. And then what's going to happen is as we make payments, we are going to amortize the discount. I'm going to say that again. Every time we make a payment, and we're going to make 20 payments over time, we are going to amortize the discount. So the journal entry to pay interest is normally a debit to interest expense, skip a line, and a credit to cash. So what we're going to do is we're going to figure out how much cash we're going to pay, and then we're going to start whittling away the discount. So I equals PRT and the amount of cash we're going to pay. This is a $2 million 9% bond paying interest semi-annually. Now, this is the rate, this is called the stated rate, the 9%, because that's the rate we are paying. The investor doesn't know what the market rate is. Like they don't know the market rate. They know on their bond certificate, it says this bond pays 9% interest. So that's what we're going to use for what we give them in cash. So I equals PRT And this is a $2 million bond that pays 9% interest semi-annually, half a year. Okay. So 2 million times 0.09 times 0.5, the investors are going to get $90,000. We know that each one is going to get, like, if it's, well, don't worry about that. Okay. So now what we need to do though, is we need to amortize the discount. Amortizing is whittling away the discount over time. Discount on bonds payable is sitting there with a debit balance of 20, and we are going to whittle it away. So we are going to, how you whittle? Yeah, we're going to whittle it away. So we are going to get rid of some discount over time. So to get rid of some discount over time, we need to credit discount on bonds payable. And so we are going to take that $20,000 discount and we are going to write it off over 20 payments. So we said $1,000 per payment. So we're going to whittle away some discount at $1,000 each time. So our interest expense will be $91. Oops, I didn't. So what we're going to do is we're going to do this exact same journal entry every 6 months for the whole 10-year period. So every time we whittle away some discount, it's going to make the discount balance go down. Discount has a debit balance, but then we whittled away one, and then we whittled away one more. So 20 minus 2 is how much, Claire?
20 minus 2?
Yeah.
18.
18, right. So what we're going to do is our bond has a face value of 2 million, but the balance in discount at the end of this year is 18. So we will subtract 18, and this is how it's going to show on our balance sheet. Balance sheets show liabilities, bonds payable is a liability. Discount is a contra liability, so it reduces the balance. So 2 million minus 18 is 1,982,000. So that's the number that will show up on the balance sheet for the bond. The next year, you'd whittle away 2 more. So now your balance and discount, because you would do this exact same entry 2 more times. So then you would whittle away 2 more. So then your balance and discount goes from 18 to 16, and your carrying value is now 1,984,000. The next year, and I don't have to do this many years, I'm just trying to show you the idea. 14, 1,986,000. The next year we keep going and we take 2 million minus 12. And so 1,988,000. And we would just keep doing that every year until the 10 years have passed and all of the discount is whittled away. And then we would repay the $2 million bond. Because at the end, we've got to give the investors their $2 million back. All right, so let's go ahead and let's do one more, and let's do it as a premium. And I think I'm going to make this 3 videos. So the bond sells for. So this is Durbin Inc. issues 1 million of 10-year 5% bonds with interest payable semi-annually when the market rate is 8. Our bond, the stated rate is 10 when the market's paying 8. So the bond is going to sell at 103. Now, for you guys, that rate will always be given. When you take intermediate accounting, I'll tell you how to come up with that 103, okay? So 103 means 103% of the face value. So the $1 million bond times 1.03 means that the bond would sell, because 103% is 1.03, 1,030,000. So the premium is 30,000. So discount on bonds payable had a debit balance, but premium is the opposite. So it's going to be a regular liability with a credit balance. So the amount of the premium, I'm going to take the 30,000 and I'm going to divide by the number of payments of this bond. This is a 5-year bond. So remember last time I did this part for you, when it was the $20,000 premium discount, we divided it over 20, which was 10 years, twice a year. So this bond is a 5-year bond, twice a year. So I'm going to divide by 10. So my premium is, my amortization of the premium will be $3,000. I don't know what I wanted to put there. I think I was going to put 3,000 over here. And then over here, I was going to put 30,000 divided by 10 payments. That works. Okay. So let's go ahead and do the journal entries for this kind of a bond. This is a premium. So when we sell the bond, instead of getting cash of $1 million, we're going to get cash of $1,030,000. Skip a line. And bonds payable. When we repay this bond, we only have to pay back the face value. So bonds payable always sits at the face value. That extra $30,000 is called premium on bonds payable. So then when we make our interest payments, interest expense, skip a line, and cash. And then we're going to whittle away the premium. So the premium is going to get whittled away. The premium has a credit balance of 30. So when I whittle it away, I need to debit premium for $3,000. Because I took the 30,000 and I divided it over 10 payments. So it'll be 3,000 every time. To get the cash, I need to know what this bond pays. This $1 million bond pays, this bond pays 10% interest semi-annually. So if I take $1 million times 10%, that's 100,000 times 0.5, which is 50,000. So then my debit, to make debits and credits work, must be 47, because 47 and 3 equals 50. It makes me think of the accounting joke that was here, because I just said 47 plus 3 is 50. So this accounting joke, like everybody thinks that accountants do this crazy math, but really it's like 50 plus 1 equals 51, right? So, okay, back over here. All right, so then we will do this exact same entry every 6 months for the whole time, okay? So for the whole 5 years of the bond. And so the carrying value of the bond at the end of the first year would be 1 million. And then we subtracted a discount, so we add a premium. So the balance in premium, I had 30 in there, and then I whittled away 3, and I whittled away 3 more. So the balance is 30 minus 6, which is 24. So the carrying value of the bond is 1,024,024. And that's what will show up on the balance sheet. If we wanted to do the next year, the 24 would whittle down to 18, and it would be 1,018,000. And then it would whittle away 6 more, and it would be 1,012,000, and then it would be 1,006,000, and then it would be 1 million, and we would be done. So, all right, we have one last topic, but it's going to take me probably 10 minutes to explain. So I'm going to pause this video and stop it and then restart. So.